Welcome everybody to this second seminar this term under the Political Economy and Financial Markets programme, and the first under its sub-theme of ethics in finance. And we have today Peter Montagnon, who is the Associate Director of the Institute of Business Ethics. To start with, you were a Cambridge man like me. You graduated at Cambridge, and then you went to work for Reuters. And then for 20 years you worked for the Financial Times.
That's correct. Yeah.
And then you joined the Association of British Insurers, which I imagine is where your interest in ethics and finance began, or
no, it came later. Actually, it came more directly as a result of crisis. But we'll go
right. Well, okay. Well, anyway, you
that was my interest in corporate governance and financial regulation because I was dealing with that.
Because before you were at the Institute of Business Ethics, you were Senior Investment Advisor at the Financial Reporting Council. You were also on the European Commission's Corporate Governance Forum. You are a visiting professor in corporate governance at the Cass Business School. You are a member of the Corporate Governance Advisory Group of Norge Banks, and you are a past chairman of the board of the International Corporate Governance Network. Yeah. So to say that you were involved in corporate governance would be sort of an understatement. Anyway, we have here David Vines, who has a keen interest in ethics and finance, having recently co-edited an authored a book, Trust in Finance. So I expect we'll have some interesting Q&A. Your presentation, we agree, will be on a podcast in the public domain, but thereafter Q&A will be under Chatham House rules.
Okay.
So I'll pass it over to you.
Okay. Well, thank you very much for the invitation. It's, this subject is an interesting one, and actually, in a way, I suppose this first slide is a sort of indicates where and how I got into it. I just thought it would be interesting to remind ourselves of what was going on, or the way people were talking in 2010. When the scandal was sort of really in the full swing. And this is just a bit out of The Guardian of the American Senate Finance Committee interrogating senators from Goldman Sachs, which I think speaks for itself. I think it's interesting, that it's a wonderful thing. You knew it was a shitty deal and you didn't tell your clients. Does that bother you at all? I don't recall, it says. And then, do you have a duty to act in the best interest of your clients? I believe we have a duty to serve our clients well. Well, you see, I had a conversation with David Walker around that time, in which I said to him I thought there was an important ethical dimension to this crisis, and he said no, it was all about competence. The boards and the management just couldn't cope with the complexity of the business that was going on, and I disagreed with him, and I think he would retract that.
When was that conversation with
that
him?
Would have been at the start of the crisis. I can't remember exactly, but he changed his mind quite quickly, but his initial reaction was this is all about competence. But my feeling right from the word go was that there's people have been doing things here which were basically wrong. And I mean, I just think it is wrong to sell somebody a mortgage knowing that they can't afford to pay it, and to qualify them by falsifying their income statement behind their back. This is what was happening in America. And what I found interesting about this was that it was very difficult for anybody at that time to just come out and say this is wrong. We shouldn't be behaving like this. I think it's an indication of social values, which is not, so it's not something confined to finance. But it made me realise there was an ethical dimension, and also that there is that this was the dimension which was in a way the hardest to deal with. You can actually step up regulation, make it tougher and make it harder. You can step up governance, and you can penalise people for breaking the rules, but it is very difficult to have a discussion with people about getting them to behave properly well. And there is still, I think, something of a cringe factor when the subject of ethics comes up, and I think it's a pity, because I don't think it's easy to deal with this unless we acknowledge that things happened which were basically wrong. I think the other thing I would just, before moving on from this slide, I just sort of mention in passing, because it does illustrate it very well, I think, in the financial world as it was then, and probably really as it still is, there are an awful lot of built-in conflicts of interest which are really difficult to deal with, and these are still a source of, I think, a degree of worry. But, I mean, it's interesting, too, if you think Bob Diamond in front of the Treasury Select Committee somewhat later said it's time to stop apologising and we can move on. It didn't actually say what we were doing was wrong. We're going to stop apologising now and get back to business, i.e., we'll carry on as we were. So I think that is part of the problem. And
who was it? Who said that? Was it Lloyd Blankfein?
No, Bob Diamond.
Bob
Diamond, in front of the UK Treasury Select Committee, if I recall, said at a certain point, we've got to stop apologising now, we'll go. Now, I think this is a rather wise remark, which sort of leads on from that, from the report that Anthony Salz did on Barclays. It exists regardless, culture. If left to its own devices, it shapes itself with the inherent risk that behaviours will not be those desired. Employees will work out for themselves what is valued by leaders to whom they report. And I think this is really quite an important and perceptive comment, because what he's saying is you just can't assume in an organisation that the culture will be a good one. It doesn't happen by itself. And it is not something which is bottom-up either. It's not something, if you've got good, honest employees, that you will have a good, honest culture in your business. It's actually something which is top-down. And so the first point, the first starting point of dealing with this is that the leadership of the institution, financial or not, and I think these issues and the fundamental issues around this apply in the non-financial as well as the financial sector. They're dealing with it requires a conscious effort on behalf of the top people, the board and the management, to design and embed values that they want their business to have. And I want to say one thing about this, which I think is quite important for people to understand, because we have a bit, if you go down the pub and talk about bankers, people will tell you, oh, they're all evil, awful people, disgusting, disgraceful. But they're not actually, they're ordinary people. But one has to remember that people behave differently when under pressure in a group to the way they would behave on their own. I mean, I give you a simple analogy. When I cross the road, I look and see if there's a car coming, and if there is one, I don't step off the curb. If I cross the road with 12 other people, I cross when they cross. In other words, your guard is down when you're in a group and you're under pressure. And this happens in all sorts of businesses. I often think, but I don't know the inside story, that there was something of this in the BP Macondo incident, in the sense that you could imagine the scenario, and I might be wrong, I'm just imagining it here, but you can imagine a scenario where the guys on the rig were being told, we have to do this project on budget and on time. On budget, on time, on budget, on time, on budget, on time. Oh, of course, health and safety matters. But you can feel the pressure building up, and they'll bond around that pressure, and they will behave in a way that they wouldn't behave if they were sitting quietly by themselves wondering how to take the thing forward. And so that's another reason why the culture is important, because a strong culture will actually enable your employees to act well or to make good decisions when they're in a group under pressure and they're liable to feed off each other. And that's something else that I think that Anthony Salz is getting at here. This is a sort of classic Institute of Business Ethics sort of chart. which sort of shows the order of things. I mean, the main point here is that the values which have to be decided, agreed by the top leadership comes first, and the ethics follow from the values, and that impacts on conduct, and that creates a culture which leads to a sustainable business model. My own view is that the business model bit is very important, because I think some people talk about ethics in business as if it's a bit of an overlay, it's a bit of PR to try and make the thing look better. But I think it's actually rather fundamental. And one point I would make here is that you basically can't have a business without having a business model. When I was a journalist on the Lex column, I used to ask people, sometimes leaders of industry, what's your business all about? And some of them could tell you in 3 sentences exactly what they were doing. And some of them would sputter and sort of eventually tell you more or less that they didn't really know, but it was their turn to run it. But they didn't know they got a business model, but they did, because you got a business model if you're running a business. And you can't have a business model that isn't informed by your core values. So if your core values are, we'll rip off our customers, then your business model will be about ripping off your customers. And at some point, then it's going to blow up in your face. And actually, I think there were parts of the business model of banking which were, you have to say, were about ripping off the customers. And we should talk later about why they were able to do this. My point is that the business model is bound to reflect the core values that are brought into the design of it, and it says this is not an overlay. And I think you can see other places where the business model is flawed, and I'm going to give some examples which are not in banking in this talk, because I think the issues do cross from one part of the one sector to another. Tesco has an interesting business model, actually, I think, because what you realised that they were doing when you saw the Panorama programme was that they were extracting values from both sides of the equation. They were actually extracting value from their customers. I thought I went into Tesco's to buy milk, and Tesco's kindly organised milk to be there for me to buy, and I was paying them a margin for having it there for my convenience. What I didn't know was that Tesco actually was saying to its suppliers, if you want your products on eye level on this shelf, you have to pay us a lot of money. So they were extracting value from both sides of the equation, and there's an inherent conflict in this. And their values were such that they didn't recognise that conflict, and they didn't choose to deal with it. When the customers drifted away and they still needed the margins, of course they put the foot down, the accelerator down hard on the other side, and got themselves into trouble with their suppliers. But I think also the culture there, I suspect, was one where people were coming under pressure to deliver on margins, and were worried about what would happen to them if they failed to do so, and so there was a pressure on the employees. All of this means that there's a strong cultural and values aspect to Tesco. There was a cultural and values aspect to the banks. Now I'm going to talk later about the ingredients of a strong culture, but I think it will normally always have a very important customer focus. I think actually if you're going to have a strong culture, it is going to be focused on delivering real value to the customer, and that's something which actually in the financial sector as elsewhere we need to get back to, but I don't think that we're there yet. And the point about this slide, I hope it comes across, is that culture and values are integral to the business. They're not an overlay that you can do for PR or whatever else. Now, this is where it gets a bit discouraging, because I think there are some quite strong forces conspiring against the ability of banks and financial services companies to actually get back to a situation where they're trusted by the public. And one of them is, I'm afraid, it's over-regulation. First of all, if the task is to restore trust, you can't do it by regulating, because you only regulate people who you don't trust. So the more you say we have to regulate you, the more it means we don't trust you. And the harder it is to shift the mindset towards the creation of trust. I also believe that one of the problems of having everything driven by regulators is that the regulatory world has different priorities. If I'm a regulator, what I want above all is not to wake up in the morning and find there's a scandal. I don't really care terribly about whether the business is successful, actually. I just don't want a scandal. So there's a conflict between imposing regulation on people and allowing entrepreneurialism to flourish. And I think the other problem is that you get to a state where the top management are all trying to comply. They've stopped thinking for themselves, and they're in a way infantilized by all these rules. And I think that's quite worrying. I went with a colleague to visit some directors of one of our largest banks last year, and we were told that they'd had a 7-hour board meeting which was all about compliance, and there'd been no time at all for the directors to discuss the state of the business. This can't be right, I don't think. And so I think that one of the problems is that we responded, I think, quite naturally to the financial crisis by a sort of really tough burst of regulation. But I don't really think it helps at a certain point. And I think there is a question, it's all a question of balance. I absolutely agree, but I think that we haven't got the balance right at the moment, and we're not helping ourselves sort of get to the point where we've got an industry that's trusted again by keeping up this level of regulation. The second point is lack of competition. And I just must say, I'm not an economist, I'm a superannuated hack, and I really don't think very deeply about anything like all of you do. So but I just don't understand this. You see, there must have been a failure of competition in banking, although there are a lot of banks, for the banks to be able to run a business model which was about ripping off their customers, which is what I would postulate that they were doing. You can't do that if there is a proper level of competition, because the customers can go somewhere else and get a good service. And I don't know quite why it was that we got into this situation, but there is, in the sectors where you get sort of values and ethics problems, there is quite often a connection between weakness and weak competition. I think it's true, for example, in the utility sector, where there has been lots of questions raised about the behaviour of the utility companies and the way they price energy bills and so on. There is something there about competition not working properly, and I can't explain it. I just think we need to look at it more, because I believe that if you can get the competition working properly, you're less of a risk of people going down the route of behaving badly. As it is, what's happened as a result of the regulation and the capital requirements is that people are losing interest in investment banking, which is actually increasing the concentration. I'm told that actually if you want certain products, you have less choice of where to go to get them now than you did before. That can't be good for good behaviour. And I think it's a problem which, as I say, makes it harder to restore the trust. The other thing is that free banking, I think one of the drivers at the retail crisis was the fact that the banks are locked into free banking, and they have to make a profit somehow, so they have to look for ways of gouging the market in order to make a profit, because they can't make a reasonable profit by providing a reasonable service of managing people's payments. And I think this is a huge problem, because I can't imagine any politician is going to suggest we should abolish free banking. I can't imagine any regulator is going to suggest we should abolish free banking, or any bank would dare to do it. So we're sort of locked into this difficult situation. The one organisation I think which could do it is UKFI, which has got a shareholder interest in Lloyds and RBS, and they perhaps if they had a bit of courage, they might float the question, but even they, I think, will probably not actually quite manage to put their heads above the parapet. But all these three things, I think, are going to make it harder to restore trust in banks. I couldn't resist putting this in. I met David Wright at something in Madrid at the beginning of last year. David Wright, as you probably know, was a very important figure in the European Commission dealing with the crisis. He's now running IOSCO, and he is still
talking about this to us.
Was he? I mean, he is still fulminating. I can't believe the language, but I just think, have we seen an improvement? I don't think so. We've seen 170 billion of global fines, mis-selling, manipulation of the fundamental benchmarks of the global economy, money laundering, tax evasion, and the usual excessive remuneration. Regulators will have to get tougher. So what I think this is saying is, at my own view, is the regulation hasn't solved the problem and won't solve the problem. But unfortunately, there is still a lot of people around who think they just need to put a bit more regulation out there, and then it might finally be all right. And I think that means there is a big onus on the banks to actually find a way of restoring public trust in their businesses and what they're doing. And they need to do this, because if they don't, then the David Wrights of this world are going to hold sway, I fear. And as I said, this is, however, all a question of balance. I'm not saying we don't need regulation. We do, of course we do need regulation. I just think we've got a little bit too much regulation, and some of it isn't helpful. I've always had, in parenthesis, a bit of anxiety about the ring fencing idea, because this is my corporate governance experience. It tells me that there is a big problem of accountability in a ring-fenced organisation, because the more independent you make the board of the ring-fenced institution, the less accountability there is of that institution through to the parent and then through to the shareholders who provide the capital. So what ring-fencers are asking the public, the institutional investors and other investors in the public to do, is to put capital into organisations without any control.
And we had John Vickers here too, sitting where you're sitting.
And well, I mean, he probably wasn't saying what I'm saying, but no, I think there is a problem here. There is a problem here, and it's not one. I remember when I was at the FRC, we tried very hard to get the Treasury and others to acknowledge there was a problem, but they wouldn't. But it is a problem. I mean, I just, in parenthesis also, and that's relevant to the second blob on the ad side. I've always felt that one of the responses to the banking crisis ought to be, or people in responding, we should be very careful to keep ourselves aware of the need to make these organisations attractive to providers of capital. And it's so far removed from the mindset of the people who are designing these policies that it takes your breath away. And about 4 or 5 years ago, can it be as long as that? Possibly about 4 or 5 years ago, I came across Stefan Major at a dinner in London, and I asked him, I said, given what you're doing to the banks, would you want your pension fund to put your money into the debt or equity securities of any European bank? And he didn't understand the question, and he fumbled around for about 2 minutes, and he said, well, it's all right, my money's safe, it's with HSBC. And what I think was really interesting, because that betrays the whole mindset, has been about protecting the taxpayer. There has never been in this a mindset, or until possibly now with Capital Markets Union, there has never really been a mindset about how do we design a capital market which is fit for purpose and will actually provide funding for our economy without running the sort of risks that we were running before. Regulation plays a part on that, in that. But of course it does. But actually you need to bear in mind that all of these institutions need capital in order to fund that. Yeah.
Can I ask you to say a bit more about your ring fencing point? I haven't quite understood it.
Well,
are you saying that the ring fence, it creates if you like, a level of separation between the ring fenced activity and the ultimate shareholders?
Yes. That's basically it. In order for the ring fencing to work, it's very clear the organisation has to be ring fenced. And if you look at what the Treasury and it was the Treasury producing these plans were saying, essentially was that the board of the ring fenced part had to be really very separate from the board of the parent.
That report too.
Yes, but I mean, well. Yes, but that's
no,
not
that,
entirely. It's not entirely clear. It's not. It's not entirely clear. You know, if you don't have a high what was it? The Treasury Select Committee had a high electrified fence. I mean, it's not entirely clear what that was going on in that reporting. What is quite clear was that there couldn't be duplication, much, if any, between the board of the parent and the board of a ring-fenced entity. It's a separate. The ring fencing means separation. And
if I could interject, also, it's in the Vickers report in the detail. What matters is, take a simple example: retail side of the firm and the investment side of the firm. You can't, well,
roughly,
you can't have the same people, or you shouldn't have the same people in the purest form. So that there's no, if I can put it this way, cross-contamination of the different...
But how about the upward side?
I mean, we could not work out in the FRC how the board of the ring-fence bank would be accountable to the ultimate shareholders, because for a start, the ultimate shareholders have no say in electing these people. They don't choose. I mean, this is an important principle of corporate governance. Yet, this bank is sort of self-standing. And where and yet the institutions who are supposed to put money into the capital, it's very difficult to sort of see how it's going to work from a governance point of view. I mean, I understand perfectly well that one of the sort of concerns that were being addressed by this was the fact that some universal banks were able to tap into the cheap retail deposits to fund very risky business, and of course then it was when that went wrong, the deposit protection thing came in and the taxpayer had to pay, and I understand that, but this is still leaves us with a problem. It's sort of, as I say, it's punitive, and it's actually designed to deal with the problem of protecting the taxpayer without really thinking about how to design and how to facilitate the creation of businesses which actually can fund our economy.
But are you saying that the only viable sort of ring-fencing type arrangement that is, in terms of corporate governance, then is what Glass-Steagall, complete separation?
Well, I was thinking about that coming here because I sort of thought you might ask that, and I think the answer is probably yes. I'm not sure that Glass-Steagall was right, but I think this is a sort of it's a messy compromise. I think you should probably be in one or the other, but Glass-Steagall becomes very difficult because the lines in all of this are really quite blurred. So I mean, it's very easy to sit here criticising. I've done it all my life when I was a journalist, and without having to take responsibility for decisions. But so I mean, I don't think it's easy. But I think ring fencing, which we've just sort of walked into, is problematic. The senior manager regime, that was also quite worrying, I think, because it completely trashes the idea of the collective responsibility of the board. Anyhow, I mean that as I say, my belief is we are at the point where we need to redress the balance, and I think what that means is we should reduce the emphasis on punitive regulation and enable prescriptive governance, and we should add focus on culture, measures to make banks attractive to capital providers, and as I made the point about competition already, I think it is important that we...
Can you say a little bit more about the bullet points there? Why EU remuneration rules seems to be reduced?
Well, I think the EU remuneration rules are quite unhealthy because of the way they've limited bonuses to one times base pay, with a possible exemption up to 2 times if the shareholders approve. I mean, I just don't think it's easy to manage a very cyclical business, and investment banking is very cyclical if you actually have such high fixed costs. And that said, I think my own personal inclination would be to be much tougher on remuneration than anybody's been in the past, and I would say that all bank remuneration should be chargeable to capital and paid in cash. So you have to have the cash available to pay people, and if you can't, because the capital, if you can't afford to pay any bonuses, there are no bonuses. Now you see, this is actually very, very tough, but what it would mean is that if you go back into the situation that appeared to prevail in UBS, where you had these derivatives people sort of on one side playing around, and actually it turns out losing a lot of money, and nobody else knew what they were doing, the incentive on banks like UBS to avoid situations where things were going on in sort of dark corners that would wreck the bank and destroy everybody's business would be very great. So, I mean, I think the incentives that would come from this would be quite
from what?
From creating a situation where all bank remuneration should be chargeable to capital and payable in cash. You see, one of the problems with paying in shares is you create the shares. There is then no natural limit to the remuneration because you actually dilute. Create more shares.
You're still saying that people might be paid in a way that is deferred in some way.
Oh well, yes. So what I would, I'd be quite happy to see a situation where the starting point is it's chargeable to capital and paid in cash. You might be requiring people to use that cash to buy shares in the bank. So that actually, and hold on to them for a long time. I think it's a much cleaner system than to a situation where you can give them shares which are dilutive, and there's no natural limit then, because you can dilute as much as you like effectively, and you can sort of say I'll have a bit of clawback here and all, so but that's sort of messy actually, and so in a way what I'm saying about the remuneration thing is it's too complicated, and it's not really achieving much of an effect, except that it's going to make these banks harder to manage. And I've never been a great fan of it, but I mean, I'm sure we can carry on discussing this. Come back to that.
That was the bit, okay. Overly prescriptive governance?
Well, what I mean there is that actually there is so much now around. You have to have a risk committee, you have to do this, and you have to organise things in a way. And also, I think the approved persons regime has also meant that it's taken away the freedom of banks, a lot of freedoms from banks, to sort of organise their affairs the way they might wish to. I mean, I understand there is a need for regulation, and I understand there is a need to ensure that governance in banks is good, but this has become very prescriptive, and I think at a certain point it becomes self-defeating. So anyhow, it sounds as though this is going to be more discussion about this later, but I'll now I think, I mean, just to sum up, I think where we've got to, I think it's clear that it's important for boards to set values and promote them throughout the organisation, and there are ways and means of doing that we could discuss. I think one of the other things which is very important is that boards, and it's true in all companies, need to understand what drives behaviour in their business and work out how to shape the drivers of behaviour. It's quite difficult, but it can be done. I think, as we've mentioned, conflicts of interest, they need to be acknowledged and addressed, not ignored. And I think that boards also need to check whether what's happening on the ground is what they think is happening. And I've been doing some work on internal audit that I'll come back to, because that's been quite interesting. One of the points about trust is you can't make yourself be trusted, but you can try to make yourself trustworthy. And I think, you know, if you're talking about what sort of values do you start off with, this is something which I think gives you an indication: openness and transparency, a track record for delivering, and a reputation for honesty and integrity. I think, you know, this is all could be sort of seen as a bit sort of goody-goody, but I think that if you turn it round and ask yourself, do you want organisations to be obfuscatory, and do you want them to be not have a track record for delivering, and do you want to have a reputation for dishonesty and lack of integrity? Would you want to work for such an organisation? Most people will say no. So these are, I think, quite useful things. The track record is very important, and I think this is again something which is going to be difficult for the banks, because the reputation for bad treatment of customers is so deeply embedded. I went to see one of the major banks last year, and they were talking about teaser rates, and they didn't like them very much. So it's to say, you give somebody a very good rate on a savings account, and after 6 months and it sort of suddenly disappeared and you don't tell them. And I was reminded, or I reminded them, that I bought into a deposit account in ING Direct when they were saying that they weren't going to do this, and they did. And I said, it'll take 10 years before I believe that you won't do it. It's going to take a very long time to restore the track record, but you've got to start somewhere, and I think this is really important. Actually, you've got to deliver.
Do you have any idea whether NatWest have had any success with this tactic? I assume you're talking about NatWest.
Yes.
They've been
yes.
pushing this.
I don't know, but actually you guessed basically, although the camera's running, you guessed right.
Yeah.
I don't know, but I would be a bit surprised, quite frankly, because I think the point I'm making is that we are so used to not getting this right, that it's going to take a long time, and it's got to be also exemplary. And I've one or two experiences I've had, actually, funnily enough, where it's indicate that it hasn't changed that much. Yeah. And I mean, for example, I mean, it doesn't want to sort of reduce this to the personal, but it is interesting what happens. Yep. My wife had a deposit in one of the big banks, which matured, and they sent her a letter which said, if you do nothing, we will renew this deposit at 0.25% per annum, but if you ring us up, we'll renew it at 0.75% per annum. You had to read very carefully through a long letter before you got to this point. In other words, they were relying on the inertia that she would do nothing, and that they would be saved 0.5 percentage point on her interest. And this was within the last 6 months. So this means that some people haven't learned. And so, you know, but
that's quite clever sample selection, isn't it? Because the customers who are determined to get a good interest rate will be those who read the letter carefully. and therefore be persuaded.
Yes, I suppose that's right.
I haven't. Econometricians call it sample selection bias.
Oh, is that right?
It's rather clever.
I just did rather enjoy filling out for my wife the form they sent round saying, "Why didn't you renew your deposit?" But there we are. Anyhow, I mean, I think these are the sort of things that the boards need to look at and need to learn how to deliver. This is a slightly sidetracked thing, but I think it's quite important to see if you look at the sort of literature here about what drives bad behaviour. By far and away, in the sort of broader economy, by far away the largest thing is when people are given unrealistic objectives or deadlines. By far and away the largest sort of thing is that. I think, of course, there are, as I point out in the slide, other factors at play in banks. So the sort of remuneration arrangements, and I think the team rather than corporate loyalty, that's something which you do see in banks. There are a lot of silos, and a lot of them actually arose because banks acquired businesses and they didn't integrate them properly, so things were going on where you got teams being loyal to themselves, not to the organisation that was employing them. And that's, by the way, another reason for having group-wide values, because if you need to integrate acquisitions, you've got to have a strong set of values to start there. I want to say just one thing here also, which I didn't put on the slide, but there was a continental banker, who told me that they had an office in New York, where their executives were desperate to do subprime mortgage business, and the board in Europe said, no, this is dangerous, we don't want you to do it, no, you can't. But this guy said that the executives just chipped away at them because they wanted the bonuses. The people in the competition were getting the bonuses, and they couldn't accept that they were denied this opportunity to earn huge bonuses. Eventually the board at head office said, oh well, all right then, and then of course disaster hit. But this is what I call sector contamination, and it's something I've been sort of discovering is a really quite important risk to culture, is when you're importing bad culture from your competitors because you're competing with them, and it's something which clearly was happening in the banking sector and something to watch out for.
Nomura Lehman is a very good example of that, when Nomura bought the Lehman businesses.
Yes. Well, there you go. You see,
I've had someone quite senior in a universal bank say that it's not just sector contamination, it's within institution contamination.
Well, that could
because
be.
the people down here on the third floor do straightforward things well and for low pay, and up on the 11th floor are all the king hitters that make lots of money, and the trouble is, as he said to me, they have lunch together. and the people, and roughly speaking, he said, and after lunch, all the people from the third floor come and see me and say, we want to sell, some prime mortgages, doesn't matter how horrible it is, we just want some way of making as much money as the people we have lunch with.
Yes.
And that's a kind of within the institutions version of
this. No. I mean, I think it's true. That's true. But I mean, I think it's certainly in the case I've given, the example I've given you, it was coming. They were trying to resist it, but they couldn't in the end, because that's an indication of how strong the pressure was on them. I've just put in this thing about 3 lines of defence. I don't want to say very much about it, except that this is the sort of fashionable way of looking at it. I got interested in internal audit last year, and I've been coming towards the end of a project on it, where I have been talking to 6 organisations about the role of internal audit in assuring culture. Because this is a very fashionable thing for them to be doing, and they find it quite difficult because culture is something that's difficult to measure, and internal auditors like to measure. So some of them run away from it, some of them quite excited by the challenge. And I talked to, I'll give a little plug for this, it's coming out in July. I thought it would be interesting just to talk to people, and as if I was a journalist again, just let it run verbatim. So I've got these people talking in their own words about how they've approached this. The subjects are Mike Ashley, who is chairman of the audit committee at Barclays, Scott Strachan, who is the head of internal audit at Aberdeen Asset Management, who, by the way, believes or claims to have audited culture within his organisation. He set out to do so, he claims to have done it. I talked to the head of internal audit and the head of ethics and compliance at Airbus to give a bit of variety, and I talked to Tatum Lyle, NEC, and also I talked to Sarah Hogg, who is chairing the audit committee at John Lewis, to get a perspective there, because there's a different governance structure, obviously, and a different culture. And some of the conclusions are quite interesting. One of them, which comes across very clearly, is that the way objectives are set and the way performance is appraised is a key issue. It's a bit like the example I gave with BP. I think the point is, it's a preview of what Mike Ashley says, is that in Barclays, and I'm sure the other banks have done this, they're no longer remunerating people on the volume of sales of products like payment protection insurance, because they know that's toxic. But it is still the case that the branch managers know that they have to turn in a profit. You can't get away from that. It's a business. It has to be profitable. And there is still a risk that the branch managers may be saying, well, to their staff, of course we know we've got to be good people now, and we've got to do things right and look after the customer and so on. We've been told that, we know that. We've got to turn in a profit. And this is stuff that is very difficult to get at, because the board isn't likely to know that that's the tone that's being used. And the signals are sometimes subliminal. But the way that objectives are set and the way that performance is appraised is a key issue. What are people being told to do? How do you know what signals are going through the organisation? He believes that internal audit can help assess that, but it requires quite an effort, a sort of 360-degree effort to sort of get it right. But I think it comes back to the point I made earlier, that actually unrealistic objectives or poor objectives are a big danger. And so internal audit has a role in this. The other thing...
I've had a couple of people say to me that they don't trust what they're told by the lower level management in answer to this question. No,
and I mean, I think one of the problems in the banks is that the guys at the top get it. They know they've got to put good values through the organisation. So to some extent, the people at the bottom end get it because they want to be nice to the customers, and actually they've seen the high-level values and they rather buy into that. It's the middle management where...
That's your point 6, right?
Yes, which is, watch the middle ranks. It's the middle management which is very difficult. I think one of the other things about internal audit is that, it's not as if you're looking to see whether people have done anything which might be regarded as unethical. Actually, what's quite a good indicator is how they respond to, for example, expectations that they file reports on what's happened. So if you're in a division where the divisional manager is actually late in filing reports on key issues, there is an indication of attitude there, which can be indicative of a poor culture. And so there are things around that are actually both measurable and indicators of risk that are quite useful for internal auditors. I think point number 4 is worth just drawing out. it's pretty clear. You can tell, I think, what sort of the overall. If you've got a bad culture, it's sort of visible a mile off. If it's generally bad, the problem is, and what the top management and the boards need to know is where are the pockets of bad culture within the organisation where people are behaving wrong, and that's again something that you want the internal audit to tease out. And in a way, this notion that the regulators are suggesting that internal audit ought to be assessing culture is fine, but actually they won't get a very helpful answer if they're looking at culture overall. They'll only get a helpful answer if the internal audit is able to sort of pinpoint the bits of the organisation where the behaviours are bad and the organisation is therefore vulnerable. I think the other thing, which is really sort of comes across from the better people in internal audit, is that actually this root cause question is a really important one. When something's gone wrong, people tend to look to see what happened, but actually you must ask why. Again, I think Tesco is a very interesting case study because, as I indicated, I think there is a big cultural question underlying that. But it's what you can see the tendency of people. We need to find out what's happened. When they found out what happened, they tend to stop there. What you need to know is why. What's driving this? Because actually, that's where you can correct. You can, if it's contrary to the values you want, that's where you can correct it. And so, that's some thoughts on internal audit. These questions, I think, probably I won't go into a great deal of detail because I'm running on rather long. But they're sort of, I just in passing say, when I was working with shareholders, some of the questions that are on this list we'd never thought of asking, but actually they can be very revealing, and they can reveal a lot about risk if you ask them.
Don't go before we've just taken them in.
Oh, I see. Right. Well, I'll witter on a bit while you're writing in that case. But I'll give you an example. I went to a presentation not long ago by Ferrovia, which obviously owns a chunk of London Airport. And they were proclaiming how good their corporate governance were, and they went through and explained how they ticked just about every box in good governance, but it was so process driven that I became suspicious. And so I stood up and I asked them, I said, your business is one where health and safety must matter, and so I'd like to know, this was the company secretary, I said, I'd like to know how often your board discusses health and safety and whether it comes at the beginning of the agenda or at the end. And he couldn't answer it because the answer is they don't. And actually this is very revealing of a quite major risk there. 10 years ago, I'd have thought questions like that from a shareholder, it's tree hugging, and it's not relevant. But actually, some of these questions that that shareholders can ask about behaviours can be very revealing in terms of risk. And I think the questions 2 and 3. Well, all of those questions will tell you something about values, culture, and how they're managed within the business. All right, can I move on now?
Yes, except that I hope in discussion we could come back to 4 and 5.
Yes. No, that's fine. I mean, the 5 we sort of has come up in
4.
Especially 4. Yes. No, I think that's absolutely right. I think that's absolutely right.
Indicator of great value.
Yes, that's right.
But are you saying that shareholders have an obligation to help improve corporate governance? I mean, is that
well, yes, I do. But I mean, although I think we probably relied on them too much, because I think they're more limited in what they can achieve than people think. But I do think they can help, and they can help by sort of needling some of these companies, and some of the questions that they ask. Well, they can probably refine the questions they ask, and they might get some more interesting information if they did. That's my sense. Yes. Anyhow, so we'll just move on. policymakers. Actually, this is the last slide, I think, in fact.
Just stop you for a minute.
Yes.
What happens if they do get the shareholders' question, don't get an answer? What actually happens then?
If they don't get an
If they
answer.
do.
If they do. Well, I mean...
If they get in there,
well, I mean, shareholders can ask. You can go around. A lot of banks, certainly companies in this country, actually they fairly regularly meet the sort of corporate governance side of the institutional investment houses, and these are the sort of questions that might be asked. But I think there are. I mean, once the questions start to be asked by the shareholders, the board is under some pressure to do something. I mean, you can't make boards do something, but actually, if you're a shareholder and you can ask these questions and the answer's not satisfactory, it's a signal to you that your investment might be quite risky, and therefore you might either want to sell, or you might be very much aware that you need to be monitoring this very closely because you might need to sell next week or the week after or whatever. And so it is quite a good, and then there's a market issue. But I mean, I had a lot of experience when I was in the ABI of something where the shareholders do have a sort of very definite interest, which is succession planning, that is actually really extremely difficult to do, because it's very difficult to get for the shareholders to say you in time or get the message through in time to a bank or a company where the chief executive or for whatever reason the chairman doesn't want to address a looming succession issue. It's very difficult to make them do it, but you have some obligation to put them under pressure. I think, and ultimately, if you want to, you can vote against the re-election of all the directors, but it doesn't often work. Anyhow, the last question. I mean, I think when we talk about policy, I think we need to look at ways, instead of piling on more prescriptive regulation, look at ways of using the regulatory process to facilitate and encourage boards to build up trust. Stick and carrot matters. I think that I still believe that actually where the rules have been broken, people are getting away too easily. I'm still just sort of gobsmacked, to tell you the truth, that the FCA, as it now is, still hasn't published its report on HPOS. Still. And if you're an ordinary citizen, you actually, it's like the Chilcot inquiry. If you're an ordinary citizen, you presume that the establishment looks after its own. And I think that where rules have been broken, I think there should be penalties, and they should be much more public. Interestingly, I don't know where we've got to now, but a couple of months ago I read in the press that one person has been prosecuted for rigging LIBOR, but we're not allowed to be told that person's name. Whereas this unfortunate, hapless, naughty person who conned Southern Network South East or whatever it is on his season ticket going into Cannon Street has been all over the press and deemed to be not a suitable person for working in the city and so on. But actually we've had a prosecution, which must be a matter of public record, on LIBOR, and the person's name is protected. Is that because it might jeopardise a subsequent case? But actually it plays to the impression that the public has that these people are being protected when they've done something wrong. And I think the counter side of giving the banks an encouragement and the freedom to work on making themselves trustworthy is that there needs to be a clear deterrent when people have done something wrong. They need to be seen to be punished. Examine the link with competition we've discussed. Establish a better track record on prudential supervision. I do actually think is quite important. My members in the ABI, when I was there and this crisis hit, were very upset because their view was that the prudential supervisors could see inside all these institutions, and they were relying on the supervisors, and they found out that it was a big mistake, and they were then absolutely spitting when those very same people turned around and said, you shareholders should have challenged the banks. You know, we've got to get, I think, to a situation where there is trust also in the supervisory regime, and that doesn't exist. And that's probably it. I think I've gone on far too long. Anyhow,
Well,
thank you.
Thank you, Peter, very much indeed for
Yeah.
that. We'll now move on to